Trading the gap fill can be one of the most rewarding trades you can make, but it's often a very high probability trade. In this video, we're going to walk you through not only what the gap fill trade is, but how to identify it and take advantage of it in your own trading. Welcome on into the TC Trading channel, where we put together some awesome trading tutorials that are meant to benefit you. If you guys like these types of videos, consider hitting that thumbs up button and subscribing to the channel, but let's dive right on in. So first off, what is a gap? Well, a gap is a difference from the closing of one candle to the opening of another candle. Now, it's mostly seen on larger time frames. We're talking daily and weekly time frames, where each of the candlesticks that you're looking at is 1 day or 1 week. The reason why is because there is after hours and pre-market price action, and we can have big time movement in the after hours or pre-market overnight, or let's say even over a weekend, and those can provide gaps on a daily or weekly chart. However, there's also gaps on shorter time frames, which we're going to talk about in just 1 minute. Here are some examples of gaps. Now, what we see right here, we have a box drawn in. Let's get rid of that so you guys can see what we're talking about. But that is actually right here on this chart of SPX, the S&P 500 index. What we have is each of these candlesticks are 1 day, indicated by the 1D here on the TradingView platform. If you want to follow along with this platform, there is a link for a 30-day free trial in the video pinned comment and description box down below. Hands down, the best platform for charting and analyzing stocks, and a lot more where that came from. It's not just stocks. But take a look. So we had this day here on October 6th, and the next day on October 7th, we have a gap down. There's just no price action in this part of the chart. That is called a gap down. Actually, a couple days prior to that, we had a gap up. There was no price action in this range of the chart from looks like October 3rd to October 4th. So those are two examples of gaps on the chart for SPX. Here's a look at Google. There's an example of a Google gap up, and many of these gaps actually tend to coincide with big pieces of news, whether that's for the overall stock market or for individual stocks. And we have earnings reports that can be a big player. So take a look at this earnings report back here in early 2021. Look at this gap up overnight on Google. That's a big gap up on Google, and that's an example of a gap right there. One more example. Let's take a look at Tesla. Stock has a ton of gaps. We have one actually highlighted right here. It's actually much more of an area that we have highlighted, but if we kind of zoom this guy in and show you what we mean, there's a gap also involved. There's actually a gap to the downside here on Tesla right in there just from a few weeks back from we're filming this video. And if you zoom this out even further, you'll notice that there are even some more gaps. Take a look at this. If I draw another box right in here, small gap, but there's another gap right there. And what you want to do with gaps, and especially because of price action over time, is extend those gaps over to the right of your chart. Because now, depending upon where we are in terms of our current price action, those gaps may be more interesting to our potential trading plans, which we're going to get into. Now, these gaps are seen over days and weeks, and when they're looked at over days and weeks, they can very well take days and weeks to actually play out and fill. But there are more gaps every single day, and that's when we talk about overnight gap ups and gap downs. Now, this is something that we're going to look at, for example, on a Tesla. We go to the 5-minute chart. On TradingView, we have this darker shading right here. That's regular trading hours. This blue color is after hours, and this kind of a yellow tint color, that is pre-market trading. So what we're looking for is gap ups or gap downs from the prior close of the prior day. So for example, back here on October 12th, when we're looking at this time frame, we have Tesla closing the day right here. Okay, so it closes the day up around this 217 area. The next day, because of pre-market price action, it opens the day down here at around 208.50 or so. Okay. What this gives us, let's say this price action is unknown, right? We have a new day, or for example, let's just kind of play off of this. We kind of have a potential gap down scenario playing out in terms of the next day. We closed on Tesla right here at around this 204, 205. Let's just say we opened up around 202, let's say on Monday when we resumed trading for Tesla. This would indicate a gap on Tesla's chart from the prior day close into the next day open. And that is opportunity. So we see these gaps on much shorter term time frames, and those could be awesome opportunities for shorter term trades and day trades. So it's not just a swing trade approach, and it's not just, a big picture approach. Those are some great gaps, and they're very easy to visualize, but we do see this all the time across more volatile time frames and with a little bit more noise, but they're still very valid setups. Okay, so now we have a good understanding as to what gaps are. Let's talk about how to take advantage. Now, first off, we want to mention this. All gaps do not need to fill, but many tend to fill. There's a higher probability that a gap can fill versus not filling over the course of time. The longer time plays out, the higher the probability. But nothing is 100%. That's our edge, but we have to understand that nothing, especially in trading, is 100%. So while you can be right many times, and these gaps may fill, let's say 60, 70, 80% of the time in your experience after you start watching them, they do not have to fill. And that's where people get into trouble. When they start thinking that it has to fill and they start averaging down into a loser, hoping for it to come back and fill the gap or hoping for it to make that move. That's why actually defining a risk is very, very important. So let's talk about swing trading first. This is going to be great for those who love to swing trade. So when it comes to swing trading and we look at gaps, let's go to the 1 year, 1 day chart. Each of these candlesticks is now 1 day. We're looking at SPX, the S&P 500 index. What we are looking for is we are first looking at the big picture daily chart. Identify gaps. Look to the left, okay? Now, when we look to the left, the closer the gap is to the current date, the current time frame, the less likely or the weaker that fill potential is. As time goes on, that fill potential actually increases. Okay, so what we're looking at right now is a couple of days, about a week and a half or so of trading, not even in terms of SPX, since this gap was made. Now, the longer that time goes on, the higher probability that this is going to fill. But what we need to do first is identify a trend. So when we're looking for gaps to fill back to the upside after big moves to the downside, which we have seen many gaps to the downside here across SPX as we broaden this chart. Look at some of these gaps right here, back here in early to mid-June. Look at those gaps right there. When we're looking at that, we want to start to see a trend develop. And so what you want to start to see is higher lows that can allow you to take the trade. Now, when it comes to the daily chart, you want to be looking at all these daily candles. How are they closing? Are you developing higher lows, double bottom signals? Is there a trend reversal signal? So if we zoom this back out and we kind of take a look at what we had back in June across SPX as an example, what we see is that we had a clear downtrend. Okay, so if I'm looking at these gaps saying, oh man, those are going to be great gap fills for a swing trade back to the upside, I'm not going to blindly start buying and guessing here because we could keep on going down. There's no telling how far we were going to go down. However, we notice those two gaps, we chart them out, we draw in our levels, we have our charts set up, we see this low holds. These lows start to hold up. Now we have a couple higher lows developing here across the S&P. Maybe we take our trade over here on this candle, respecting this level right here, this 37.15 as our risk, and then we are targeting this first gap fill. So in this situation, okay, let's take a look at what this trade would be. Let's say we were to enter this trade on this day. Okay, now of course, I'm not sure exactly where you're going to be able to enter, but there was range down here to the low of the day, all the way to the high of the day. Let's just assume you got in somewhere in the middle, okay? If this is your risk, you're going to risk underneath this double bottom right here, these higher lows. Now you're looking to target that gap fill. That puts you at around a 2.34 to 1 risk-reward ratio. That's pretty good. Everyone's going to have a different standard. However, in a situation where we have an edge, knowing that, hey, a trend is reversing, we have a gap fill to the upside, potentially now 2. So we actually potentially have 2, which eventually filled. It took a long time, but it eventually did fill, which that top gap actually ends up being almost about a 4.6 on the risk-reward ratio, meaning that you're going to risk 1 to make $4.60 based off of this chart across SPX. Pretty darn good risk reward. And that's exactly what we like to look for when it comes to a gap fill swing trade play. And we are taking profits on that gap fill once it gets up towards the top of that gap. Again, if that gap happens to line up with a psychological number perfectly, what we tend to do is sell just before. So for example, this gap actually ends up just under 3,900. So you could kind of give or take just under 3,900 across SPX. This one right here looks to be about 40.15. So you could probably put a target sell just under 40.15 across SPX. But that's a perfect example of how you would execute the gap fill trade for a swing trade when looking at SPX. And again, you can do the exact same thing for the downside if there were gap ups that now potentially could be filling back to the downside. And these are very common patterns. Again, not 100%, but they are very common patterns. And the longer time goes on, the higher probability of gaps getting filled, especially if we have gap downs. Those are very, very important because we do look at the stock market over time. Yes, there are bear markets and bull markets, but over time, things have gone up. So the longer the time duration extends, the higher the probability based off of history that these downside gaps will fill back to the upside. And so that's probably your higher probability trade over the long term. Now let's talk about the day trading side. Let's go back to the 5-minute chart here across SPX. Now SPX is actually great because we are not able to look right now at pre-market and after hours trading across this chart. You can even just turn those off or turn them on depending on what stocks you're looking at. But what we're going to do here is we're going to be looking at a gap fill trade to the upside. So what we are going to notice right now, we have this VWAP. Let me get rid of this VWAP so you guys can actually see this very, very clean, okay? No indicators on our charts, or minimal indicators on our charts. What we had right here was a gap down from the prior day close right here to the next day open, okay? So what does that give us? On a 5-minute chart, each of these candlesticks is now 5 minutes. This is going to be more of a day trade, okay? So we're not looking at this as a swing. We're not intending to hold this overnight. So we start to notice, okay, 5-minute candlesticks are coming in. Maybe we did not want to take this trade across the open. We're like, hey, I don't trade the first 30 minutes of the day. I'm not going to touch it. Okay, fine. We have charted out our opening price, okay? We have charted out our closing price of the prior day. Those levels are now on our charts. You can use horizontal trend lines. It's much probably cleaner. But in this case, I just drew them in. Now what I'm looking for is a push up. Okay, so it looks like we're trying to fill some of this gap right here, right? We start to push up. Now I'm looking at a potential long trade because we gap down. I'm looking for a push up to fill that gap, and that will act as an area of resistance. Now we start to build a couple higher lows right here. Now I notice we have 3 5-minute candlesticks that are not dropping below this level right here. Boom, my risk is now set. I am going to enter a trade. Let's say I entered on this candle right here in the middle of this candle. That is the third or that's the fourth candle right there, I guess, off of that low, that higher low. We're going to risk that higher low, and we're going to target that gap fill trade. In this case, we're going to risk 1 to make nearly 3, in this case, a 2.78 risk reward ratio for that day trade gap fill. And guess what? We got it and more. We actually got a bigger squeeze out that day, but we certainly got that trade. And again, if you are looking to trade these gap fills, sometimes they're going to hit and they're going to reject super hard back to the downside. Sometimes they're going to blast right on through. And so what you can do is as you hit your targets, lock in half, lock in 3/4 of your position, lock in 2/3, whatever risk management style or whatever style you like to use, then leave that extra piece to ride if it does continue and put a trailing stop loss on it. Let's say, I don't know, maybe back under the prior or back under one of the most recent higher lows that was made. And that's now your new risk. So this way you could capitalize if it does keep going. But at the end of the day, as a trader, it doesn't really matter because there will be many, many more trades where that came from, especially when you're looking at gap fills. Every single day we see gap fills up and down across all different stocks, not just the S&P. It could be really any stock out there. So that, my friends, is the gap fill trade. If you got something out of the video, hit that thumbs up button, consider subscribing for more videos just like this, and share it with a friend. It's one of our favorite trades to play off of when it comes to swings and even day trades. And again, if you want to follow along and use this platform to chart your levels, risk reward, get all your lines in there, everything, this is TradingView. We'll leave a link to TradingView in the pinned comment and video description box down below. Thanks so much for watching. Tons of other great links and resources are also linked down below, and we'll see you guys in a future video. Peace.